The Fed didn't offer too much for the markets today, not offering that much of an acknowledgement of the market volatility, economic concerns. At least the market didn't seem to like what it got. Is the Fed going to have to capitulate even more towards the market at its March meeting?
I mean, the Fed did give you two looks at the idea that global issues, global financial issues, and global sort of financial stability issues more generally are going to play a role in their decision, and in particular, how they impact the models at the Fed for the labor market and their inflation forecasts. But I suspect the market is still, still in one of these very precarious places where smaller flows are going to drive these short-term trades. We're still bouncing around with oil. We're still bouncing around with China. The Fed is in the loop, and I think people were maybe hoping for something a little bit more. I don't know that the Fed could have given you a much more dovish statement given the off-cycle meeting, but I read that statement as reasonably comforting that if things were to deteriorate, they are going to sit on the sidelines and watch and be reactive to anything that sort of gets in the way of their view that inflation is heading back toward 2% and that the labor market is continuing to heal from the crisis.
Yeah, sitting on the sidelines and watching. Carl Riccadonna points out the fourth quarter GDP numbers, Alex, is coming out on Friday. The FOMC didn't have it on hand, but economists are looking for the number to miss the Fed's forecast when you look at the full year. And Carl figured that the Fed has never raised rates when GDP was sub 2% on a year-over-year basis.
Oh, that's a great point. David, we're talking about that lower growth for the fourth quarter. What do you attribute the recent market sell-off to over the last few weeks? Is it oil? Is it China? Is it global growth? Is it central bank policy mistakes? Is it global liquidity tightening? I literally hear a different answer every day.
You know, I think the jury is out, and my personal view and the view that we've put forward to our Jefferies clients in our writings earlier this year is really one that's focused much more on the energy trade, and that there's a lot of flows coming from distressed players in the energy market, and in particular those that have built up large nest eggs of sovereign wealth and are needing to tap some of that sovereign wealth because with a 70 or 75% downdraft in their revenue generating machine, their energy asset, they need to come up with some additional revenues, and they need to figure out how to rebalance a broken balance sheet. So we think there's a big flow going on there that's very difficult to measure. Nobody really tells you exactly what they're doing in that space, but we think that's a real flow that is holding back on the market, and that really there's not a Main Street story. There's a financial market / Wall Street story, and that we're going to find over the course of 2016 the data come in okay, probably even a little better than okay, and that the consumer, which is delevered a lot, has healed quite substantially from 2008, and this is really more of a financial crisis than any sort of looming recession-like crisis.
So if the Fed isn't inclined, it's not going to. It would be very unlikely for it to restart QE. But you have all these sovereign wealth funds continuing to have sort of what some people have called like a reverse QE effect. When does the market turn around?
Great question. I wish I knew the answer, but I think
well, what would cause the market to turn around?
I think what causes the market to turn around is fundamentals. Fundamentals that the U.S. economy is not heading into a recession anytime soon, and we are looking at a market which is trying to price in the odds, significant odds, of a recessionary outcome. And as the data come in somewhat more robustly than maybe what the market is forecasting, I think that's going to be where the rubber meets the road between sort of Wall Street and Main Street, or the shorts and the Fed. I mean, the shorts are really pressing it here. They've had a great start to the year. You have a lot of momentum traders, the CTAs, that have gone with this trend. And so there's going to be a lot of flow into a relatively illiquid market, and we all have talked about liquidity on your show, Joe, for a long time. So I think you can attribute it to that, but we're really sticking to this view that this isn't a sort of Main Street / recession story. And if anything, if it develops in a negative way, it's going to be much more like one of the sell-offs that we had in the late 90s, where the U.S. economy was doing quite well, but Wall Street went through these periodic bouts of stress related to emerging markets, related to energy, related to long-term capital, whatever you like to